Welcome to ETF Leaders, powered by the New York Stock Exchange. I'm Judy Shaw, and joining me today is Lance Humphrey. Lance is the Global Multi-Asset Portfolio Manager with USAA Asset Management Company. Lance, thanks for joining me.
Great to be here.
So Lance, tell me, with the proliferation of smart beta ETF products, how do you decipher the ins and outs of the various products?
Well, I think it's really important to have a very consistent framework. Coming from the space where we evaluated active managers, people typically fall back on what they call the 4 Ps. So people, process, philosophy, performance. But when looking at smart beta ETFs, we really need to develop a new framework on how we think about those types of things. And so what we look at is what we call the 5 Cs. So combination, which is if you're putting 2 factors together or more, how do you put them together? Do you put them together separately, 2 separate portfolios combined into one, or do you try to integrate the portfolio together? Number 2 would be the concentration. So how many stocks are you choosing from the universe? If you're starting with the S&P 500, do you take half of that universe, or 25%, or 10%? That becomes a very important consideration. The third would be construction. So once we choose the stocks that we want to have in the portfolio, how do we want to weight them? Do we want to weight them by their market capitalization, or do we want to simply equal weight them? Again, these can play very important parts in the outcomes for investors. And the last 2 would be things like constraints. So is the portfolio sector neutral? Is it region neutral? Are there going to be biases set from those types of parameters? And then the last would be craftsmanship. So how is the ETF built? What is the turnover frequency? What is the rebalance frequency? Are there things in place to help dampen the trading costs or other frictions? And so again, those 5 Cs we believe are very important into defining the outcomes for investors.
Do you have an example of how these considerations have impacted investor outcomes?
Yeah, if we think just to last year in 2018, we take the momentum factor, let's say. And again, the academic version of the momentum factor actually outperformed in 2018. But if we look in Morningstar, let's say, there's 18 different funds that track the momentum factor in the large and mid-cap universe. And out of that 18, only 4 actually outperformed the market. And so the question is, well, if the momentum factor outperformed, why did only 4 outperform the market in the actual marketplace? And really it comes down to things like construction. So of the 4 that outperformed, they typically have some sort of market capitalization weighting scheme. So they own the big stocks at a bigger weight. But had you invested in those same factors but done a different weighting scheme, like equal weighting or volatility weighting, it had a more adverse impact in 2018. So again, a perfect example of how these things can become very important.
Based on your own research, which of these considerations can have the greatest impact in overall performance?
Well, they're all very important, but I think, again, the weighting scheme or the construction, it becomes very important. So the difference between weighting the stocks by their market capitalization or weighting them in a more diversified manner, like equal weighting or volatility weighting, can cause very big differences in either year by year or long-term outcomes. So I think that the construction is probably the first thing that investors want to look at when making a decision on ETFs.
So what kind of portfolio weighting does USAA use within their own suite of smart beta ETFs?
Well, in our ETFs, it was very important that we focus on a diversified and balanced risk weighting scheme. We wanted to make sure that the securities that we selected all contributed about the same to the portfolio. So what we chose to do was use what's called a volatility or risk weighting scheme, in which we take the stocks that we select that are a little bit higher risk and give them a slightly lower weight, and we give the lower risk stocks a slightly higher weight. Again, what we're looking to do is balance the risk within the portfolio.
Fourth quarter, we saw a lot of volatility. We saw an increase in interest in certain smart beta strategies that focus on dividends, low volatility, and value.
We did, and what we saw there was, if you remember in the fourth quarter of last year, we saw a lot of market volatility. Many markets were down more than 10% over the quarter. And so I think one of the great things about smart beta and factor-based investing is it allows investors really to navigate those volatile times. So it makes a lot of sense that investors move to some of the more defensive factors like dividends and volatility, because those tend to do better in markets with a lot of volatility. So again, I think what we saw was investors taking advantage of those new opportunities, the new products that are available to help navigate those turbulent times.
Okay, specific to factors, where do you see the most opportunity heading into 2019?
When we think about factors, really what we call the varsity team factors are value and momentum. We believe that those are 2 factors that we want to have in our portfolio all the time. That being said, we really like value today, given the fact that it's underperformed over the last several years. The valuation levels that we see today in the marketplace look very attractive, particularly in overseas markets. So we have an overweight position there. And then when we look at some of the other factors today, we do like quality because it does have some of that more defensive characteristic to it. And we think that given where we are in the market cycle, quality is a good addition into a lot of portfolios, and we're using in ours today.
Great. Well, thank you, Lance.
Thanks a lot. Great to be here.
And that's ETF Leaders, powered by the New York Stock Exchange.